Too many business owners are leaving money on the table when it comes to making the most of their corporation. Not only does it hold them back in their day-to-day life, but in their future as well. Hi, I'm Dave, and I help make Canadian business owners' goals a reality with innovative financial advice. Get to financial freedom sooner and start doing more of what you love, whether that be ski trips in the Swiss Alps, safaris in Botswana, or climbing the world's highest mountains. Here are 6 strategies to maximize your investments and save taxes using the power of your corporation. Let's start with what you can do today. Make sure you pay yourself a dividend and not a salary. If you pay yourself a dividend instead of a salary, you can avoid paying into the Canadian pension plan, leaving an additional $7,000 in your corporation to invest at your discretion. With that, you can save $280,000 over 40 years and have more control over what you do with your savings. Next, keep as much money as you can inside your corporation. Only pay yourself what you need to live your ideal lifestyle and achieve shorter-term goals such as a well-deserved vacation. One big mistake many business owners make is taking money out of their corporation to save inside RRSPs and TFSAs. If you decide to take money out of your corporation to put in an RSP, you will have to give half of that money back to CRA. Although you took the money out of your corporation tax-free, when it comes time to withdraw money out of your RSP, you will be paying up to 50% tax. Although the traditional route to building a retirement fund for most Canadians is by using an RSP, there are often better ways business owners can save for retirement. RRSPs are designed for you to invest in when you're in a high income tax bracket and withdraw when you're in a lower income bracket, which is often at retirement. This allows you to pay fewer taxes when you withdraw if you're in a lower income bracket. However, a part of being an entrepreneur involves building multiple sources of passive income for you to take advantage of when you retire. From real estate, mutual funds, and investments in other businesses, it's likely you will continue to be in a high income bracket at retirement. So if you invest in an RSP, you risk giving up 50% of your money to the CRA upon withdrawing, and no one likes giving money to the CRA. The same goes for pulling money out of your corporation to invest in your TFSA. A TFSA provides the opportunity to grow your money tax-free. It is advantageous for individuals who are on a salary and don't have the financial planning advantages that come with owning a corporation. However, for business owners, the cost of contributing to a TFSA may outweigh the benefits. If I make a TFSA contribution, I have to make it through me, Dave, the individual, not through my corporation, and contributions into my TFSA are not tax deductible. Consequently, you must pull money out of your corporation to contribute to a TFSA, meaning you must first pay personal taxes based on your income level. You end up having significantly less money to invest in your TFSA after paying personal tax. For example, if you're in a 40% tax bracket, you would have to take $10,000 from your corporation to invest $6,000 in your TFSA. To turn that $6,000 back into $10,000, you would need a rate of return of 66%. Just like that, you've lost the benefits of tax-free growth. A winning strategy I tell all my best clients is to leave this money inside your corporation and invest it in there. You will avoid paying that extra layer of personal tax, and you get to watch your investments grow larger and much faster. Make sure to invest in tax-efficient vehicles to maximize the growth. Click the I in the top corner for a video on that. Number 3, invest in capital gains producing investments. Always invest in capital gains producing investment vehicles as opposed to investments that produce interest. For example, stocks, ETFs, corporate class mutual funds, or real estate. If your investment time horizon calls for some fixed income for a shorter term goal, like a 3-year savings plan towards a down payment on a rental property, look at corporate class funds. The corporate class structure of the funds will ensure the income gained from the fixed income vehicles is taxed as a capital gain, saving you half the tax payable. If you're investing in ETFs, find the ones with the lowest dividend distributions. Even for very short-term investments, you can find money market funds that are corporate class and taxed as a capital gain, as opposed to settling for a GIC or high interest savings account. These options produce capital gains, which are taxed at a much more favorable rate than dividends or interest income. Capital gains lower your tax payable and create capital dividend account credits for you to take tax-free money out of your corporation. This leads us to our next strategy. Utilize your capital dividend account. The capital dividend account is one of the most powerful tools a business owner can use, but very few are using it. This secret notional account could save you millions of dollars in tax. That's right, millions. What is a capital dividend account? A capital dividend account is generally used by Canadian business owners with a Canadian-controlled private corporation. This account provides phenomenal tax advantage, allowing you to withdraw money from the corporation completely tax-free. Here are 2 ways of the many ways you can make use of your capital dividend account. Number 1, when a Canadian-controlled private corporation earns a capital gain, 50% of that gain, known as the non-taxable portion, flows through the capital dividend account. Shareholders can then take this out of the corporation tax-free in the form of capital dividends. For example, if you earn a $100,000 capital gain, you have a $50,000 taxable capital gain. The other $50,000 in capital dividends you can pull out completely tax-free. Number 2, if you own life insurance in your corporation, the death benefits can be paid out 100% tax-free through your capital dividend account. Make the most of your capital dividend account when it comes to insurance and investments, so you're winning and not the CRA. My next tip is to pay your life insurance with corporate dollars. Make sure that your corporation owns and pays for all your life insurance. Having your corporation as the owner and payer of your life insurance policies means you will pay the life premiums with dollars that are taxed at 11% in BC, as opposed to your personal tax rate, which could be as high as 50%. Here's how you set it up. Make your corporation the owner, payer, and beneficiary of any life insurance policy you have on yourself or your spouse. When it pays out, all the proceeds will pay out tax-free via the capital dividend account and can be distributed to the beneficiaries of your choice. This is a frequently overlooked method to save taxes, but it's one that can pay off in a big way. My final innovative strategy to save taxes and reach financial freedom sooner is to consider investing in corporately owned whole life insurance. This is a great strategy for business owners to grow tax-exempt wealth and to ensure that the money left inside your corporation will go to your family or the charity of your choice as opposed to CRA. Corporately owned life insurance can also be used to help create a tax-efficient retirement. To summarize, here are 6 value-add strategies to grow your wealth and save you taxes throughout your lifetime as a business owner. Number 1, pay yourself a dividend and not a salary. Number 2, keep as much cash as you can inside your corporation and only pay yourself what you need. Don't pull money from your corporation to put into RSPs or TFSAs. Number 3, invest in capital gains producing investments inside your holding company. Number 4, make the most of your capital dividend account. Number 5, own your life insurance inside your corporation. And lastly, invest in corporately owned life insurance. There was a lot in there today, but that's because I want you to make the most of your success and get ahead. Traditionally, the financial industry is not set up for business owners like us to win. We're too busy fighting with CRA and the banks to take a step back and make the most of our wealth. Thank you for watching, and if you're feeling stuck and want unbiased financial advice explained in ways you can easily understand, book a call with the link in the description below.